We're live.
All right.
Hi, everybody. Thank you for being here. I'm Heather Dreves. I'm with Central Lending. I'm the Chief Investment Officer, mainly responsible for investor relations and capital raising for the company. And I'm lucky enough to be here with Andrew in Lakeland, Florida. Andrew Boccia, our CEO. So introduce yourself.
Yeah, absolutely. I'm Andrew Boccia out of Lakeland, Florida. We're here at the office headquarters. We do direct lending here at Central Lending, and we empower investors, active and passive. So I think we're here to just talk a little bit about what we do.
Yeah, this is a treat because Andrew and I usually communicate through phone and Zoom calls.
Yeah.
I am located in Idaho, so I get to come here every quarter and spend time with the team. So it's been a good week, productive week. I had a quarterly meeting and put a lot of goals and KPIs together for the team. So we've got some exciting things, but glad you guys are all here. I know that for you folks that are on this side of the States, it's a little bit later in the afternoon and you're taking time away from, family. So we appreciate your dedication. So we're going to dive in. We've got a lot to talk about. We're going to talk about how savvy investors evaluate opportunities in private lending, how you guys can build diversified portfolios. So this isn't going to be a great webinar because we're going to talk not just about, people that are passively investing, which is really my main focus with Central Lending, but we're also going to talk about our active real estate investors and our borrowers and brokers. So we're going to dive in here. For those of you that are logged in and registered, you should be able to see a comment section. We want this to be interactive for you folks. So as we're going along, if you have questions, we're going to do our best to address all of those. We had some people actually send in questions ahead of time. So we're going to do our best to actually address those. So let's get started here. So I thought the best place to start was to really let Andrew kind of talk about what private lending is. I mean, I get a lot of passive investors that heard from a friend or heard from a guru on a webinar that they should be investing in private lending. And a lot of times they don't even really know what it is. So maybe you can enlighten us and talk a little bit about, what private lending means for your borrowers and your brokers, why they might use private lending, and, just kind of expand on that.
Yeah, private lending, hard money lending, there's a lot of these terms kind of thrown out there. To me, it's anything that's not a bank, financial institution, or credit union. So if you're working with a private person or a private small business like ours, I would consider that private lending, where there's less stringent regulations and less red tape to getting to an approved scenario. That doesn't necessarily mean it's subprime. A lot of people have the misconception that private money loans are somehow worse in quality than sort of mainstream conventional loans or non-QM loans. So these terms are kind of just all thrown out there. But yeah, private lending just means you're not really going with a bank or a credit union. You're dealing with a private person or maybe a small company.
Okay. Yeah, I think that's great because I do get a lot of misunderstanding about private lending.
Mm-hmm.
I think in the past, private lending probably had a bad reputation for, hey, you guys only deal with borrowers that can't get financing anywhere else, or they've got poor credit, or they don't have any money and they don't have a track record. That's not necessarily the case. I will say that our borrowers at Central Lending are top notch. I mean, a lot of these people are very sophisticated and do multiple deals in a year. Wouldn't you say the majority of them are repeat experienced investors?
Well, private lending has really kind of also made a bit of a change in the last 20 years. It's kind of gone from backroom, one deal at a time to now it's a very institutionalized industry. And on the one hand, that's because the performance of private lending has done very well throughout a lot of fluctuations. But on the other hand, it's getting very, very competitive because Wall Street is kind of coming into our space. They like the performance of these assets. So there's a lot of money out there and a lot of competition in private lending. And yes, we love repeat borrowers. But we will lend to new investors as long as the scope of work is light and the deal's profitable and they have their head on straight and there's good mitigating factors like credit, down payment, deal profitability, that type of stuff.
Great. That was going to be my next question.
Okay.
What do you guys look for in a borrower?
Yeah, so I mean, our system is going to track a couple hundred data points, anything from, the purchase price to the rehab budget to the ARV to the term of the loan to the interest rate. We have hundreds of columns for different data points. We look at before and after bedroom count, median sale price in the zip code. There's all kinds of data we can look at. The main ones are going to be the credit score of the borrower, the experience of the borrower, and we look at experience. We look at three data points for experience. We look at current rentals they own.
Okay.
We look at exited fix and flip projects, and we look at ground up construction. And we look at all three differently because it tells different things about the investor. And then we run a criminal background check. So we understand, does this person have liens, judgments against them? Do they have a foreclosure in their past, bankruptcy? Are they not performing with other lenders? So we have a kind of a credit profile built around the borrower. Then we look at the entity, make sure the entity's in good standing, see if there's any other partners on the entity. If there are, we do those same three checks: credit, background, and experience for other partners that might be on the entity. And then once that's out of the way, then we're down to collateral. Then we're focusing on the collateral. So what's your purchase price? What's your rehab budget? And those two will give us a total cost. We'll measure the total cost against as renovated value. That'll give us sort of a profit margin that we would want to see for the deal to be viable. We will look at the, how much of the job is the rehab budget versus advanced on purchase day. There's a lot of metrics that we look at, but the main ones are credit score, experience, and then down payment, really, and our different leverage ratios.
Okay, great. And we're going to dive into this a little bit more too. It's okay. We've got a lot to talk about today. I get a lot of investors or not even just people that are actively invested with us or interested in us, but people ask me all the time, well, why would somebody invest with you? And I think one of the biggest common denominators that at least I get from current clients and potential clients is these people are looking at a way to diversify their portfolio outside of your traditional, investment options. And I'm not here on a soapbox saying pull all your money out of the stock market. That's not what and we don't give financial advice, just for clarification. But I do think it's important to diversify. And I will tell you that a lot of the clients that come to us are previous real estate investors. They are people that have created wealth through, some of them fixing and flipping, a lot of them owning rentals. A lot of them are professionals like dentists that owned a piece of real estate that their practice was in. And then when they exited the practice, they sold it. So they are interested in typically investing in something with a real estate asset that is backing their investment, but they're at a place in their life where they don't want the headaches of owning real estate. They don't want to deal with tenants and toilets anymore. They don't want to deal with contractors and counties and permits. So it is pretty common for our passive investors to have some kind of a real estate background in their past. We also explain to them that, when they are investing with us, and we'll go into some more specifics about how you can invest with us, they're really acting as the bank, right? They're in a roundabout way providing capital for us to deploy on their behalf. And they usually invest with us, which they understand what our processes are to lend people money, how we manage those assets after we lend money. And so that is just kind of a little bit of a background of why somebody would invest with us. And I tell people, you're investing in an asset class, but you're also investing in an operator. I mean, more than anything, you're investing with central lending, trusting that Drew and the team are doing their due diligence and they're underwriting the file in a way that, and we talked about this just in a servicing meeting the other day, the work is up front, making that you originate a good asset versus trying to fix the problem afterwards in servicing. And so you're really relying on the track record. Andrew's been around with central lending since 2016. So we have a pretty impeccable track record. There are a couple ways you can invest with us. We currently offer what is called an equity member option where you can basically share in the profitability of the fund. You get paid what's called a preferred rate of return, and then you get a profit share once that preferred rate of return is met. That's a great option for growth. It's a great option, to share in the profitability of the fund. And when we hit a home run, you get a benefit from that. There's also what we call a note holder option. And this is where investors can invest in our fund if they are looking for more of a cash flow strategy, and they're trying to budget. I have a lot of people that have retired or sold businesses and they're trying to replace income. The equity member thing is attractive, but they also like the consistency of more of a fixed rate option. Mm-hmm. So coming in as a note holder is a nice option. You can get paid earnings on a monthly basis, and we can talk more specifically about that. But essentially, you're investing in a fund with a pool of notes that we are originating, we are underwriting, we are servicing. The fund makes money off of things like origination points, interest income. You mentioned we sell a lot of our assets to Wall Street. When we sell these assets, we tend to,
not all, but yeah.
But we do keep an interest strip on those.
Yeah, they actually cleared 10 of them downstairs today. So yeah, they're busy down there.
Yeah, and what that does for the fund, just so that people understand, is instead of limiting us to be able to originate the money that we have in the fund, and then we have to wait till something pays off. Or they exit our loan to originate more. We have the ability to originate, sell those assets off, and rinse and repeat. Mm-hmm. And it does make the fund more profitable. So let's dive a little bit deeper. When you have a deal that comes across your desk, you kind of touched on some of the key elements that you're looking for. Mm-hmm. One of the big hot topics right now is markets. I get calls every day from investors that are invested with us or thinking about it, like, what's your take on the markets? And I tell them, well, I don't have a crystal ball, and it's hard because we're in a lot of markets. So how do you evaluate that?
Yeah, I mean, the market is just one, the market and the very local market is just one piece of it. I'd rather have a very good loan with a very good borrower in a market that's a little bit, that has maybe higher days on market than a bad loan in a hot market. So I'm more focused on the borrower, their deal in that market, and how much cash they're putting down, sort of protecting our position, because good borrowers know their market. They know the nuance from one neighborhood to the next. They will explain it to you. They'll talk about, of course, I can go on Redfin and look at, zip code variation and year over year and look at how much inventory is on the market. And I do that, especially on bigger deals. But I'm more concerned about, does the borrower know the market, and are they taking the market into their pro forma projections? So we at Central Lending, we have a focus on the Southeast and the Midwest. We don't lend on the West Coast. We try to avoid states that are, how do I say this, tenant friendly. And we try to stick with traditional housing where there's an exit for a DSCR option where you rent it out, or you can sell to a conventional buyer, or you can sell to a landlord cash and they can cash flow. There's multiple options. And whether that's in, Winter Haven, Florida, I think was a question that came in, or Polk County, whether that's in, Central Florida or Columbus, Ohio, we're in the Southeast and the Midwest, and we're in that traditional housing model. Our average loan amount is very small. I talked to other people in the industry. Our average loan amount is $200,000. Yeah. So these are smaller units. We try to not concentrate too much into one borrower, and we try not concentrate too much into one market. But I would sum up our strategy with being long-term bullish on the Southeast and Midwest.
Okay. How do you guys feel about
even though we're having a little bit of trouble right now in Texas and Florida, some of those markets got built up very quickly and there's a little whiplash. So yeah.
Yeah, but that's something we look at every single week. I mean, just for you guys' reference, I mean, we meet with processing almost daily. I think we just cut back meetings, maybe 3 or 4 a week. So we do a deal review, and we'll talk a little bit more about that. We meet with our servicing team twice a week. So we keep a real close pulse on what's going on with our portfolio and when we start to see issues in certain markets. So for example, we start to see a lot of borrowers not being able to pay off and they're asking for a lot of extensions.
Yeah.
A lot of times when you start to look at that as a portfolio, you'll notice it's concentrated in certain markets. And, we may make decisions quickly from an underwriting perspective that we pull back. Maybe we're not lending 70% and we pull back. So, those are things that we look at daily. And those are typically your biggest red flags. Talk a little bit about the metrics, and these terms are thrown around out there, and I don't know that everybody understands it. LTV, ARV, LTC. Dive a little bit into that.
Yeah. So kind of everyone, I think one of the biggest mistakes people make, both borrowing money and buying these notes, is they will fixate on loan to value as like the one metric that drives sort of the strength of the deal. And it's really an overhyped metric, in my opinion. So everyone said, what's the LTV? Oh, it's 52. Oh, cool, I'm in. And like, end of story, right? The problem with LTV is you're looking at loan amount and then you're looking at value. Well, what's the value? Well, it's some person's opinion. So, you ask 5 appraisers for an opinion of value, you're going to get 5 answers. So at Central Lending, we look at 4 leverage ratios. We look at loan to current cost, which is how much are we, the lender, advancing on the closing day versus the borrower's purchase price. Okay. So in simpler terms, what's their down payment? That's our first metric. Obviously, the higher the better for us. Now, and that's not very popular on marketing material because borrowers want to be in for as little as possible and do all these different deals. So that's a battle in the market that we're fighting with other lenders. Obviously, we want low leverage. Borrowers want high leverage. Good borrowers have a lot of options. So we have to bring other things to the table, like good service, speed of closing, good software, that kind of stuff, so that we can get the right borrowers to still justify putting in a good down payment that makes us feel secure. But anyway, the first leverage ratio is down payment. So we call that loan to current cost. The second leverage ratio is loan to as is value. So that's what's our advance, the lender's advance on the closing day versus the collateral value today. So not improved. The third leverage ratio is final loan to cost. And so that is our total loan after we've sent out all the construction funds, project is done, measured against the borrower's total cost. So for example, on a ground up construction, let's say the land is $25K and the build is $175. That's a $200,000 project. If we lend $150, our final loan to cost is 75%. And then you have loan to as completed value. So that's what's our final loan advance over the final collateral value. So in that example I just gave you, let's say that the appraised value of that house is $300 and our loan is $150. Our loan to final value or loan to finished value or loan to ARV, whatever you want to call it, is 50%.
Okay.
So we look at 4 leverage ratios. 2 are before construction on the closing day, and 2 are finished project metrics. And then 2 of the leverage ratios look at the property's value weighed against our advance, so our risk, and 2 look at our risk weighed against the borrower's risk. So how much are they putting in versus us?
Okay.
And we have a cute quadrant in the office and some flyers that we send out about this. But those are the 4 ratios. If all 4 are in check, you're usually pretty good.
Okay. One of the things that comes up when I'm dealing with investors looking at investing with us is some people have an opinion that ARV lending, which stands for after repair value, this is when we hypothetically are lending them money and also providing the rehab funds. Sometimes it's purchase and rehab, sometimes it's just rehab, but we're basing that ARV value off of a completed project. A lot of questions that come up is how do you guys manage that and mitigate risk with that? Are you giving them all the money to go rehab it? Talk a little bit about that, because I think this is really interesting. I don't think people understand the work that goes into managing those types of projects.
Yeah, construction lending is very, very interesting because the collateral is changing, by definition, changing every day.
Yeah.
So it's kind of like trying to nail Jello to a wall. And we have a pretty fantastic team that takes care of our draws. So there's 2 people on our draw team, and that's what they do. They're experts at construction draws. We use a third-party app called SiteWire. Basically, the borrower will, submit a draw request. They'll use the SiteWire app, and it goes right on your iPhone or smartphone. There's great fraud detection metrics on it, so we know if it's a builder and they take a picture of another air conditioner across the street, we're going to know because it's geolocated, time-stamped, and so on and so forth. What's cool about the tech is it'll also show you the angle that the camera is facing and the exact GPS of the location of the camera when the photo's taken, and we can tie that to the proper site. So it's really cool technology with SiteWire. Borrowers love it because it's instant. But anyway, they'll submit a draw request. They'll use the app. Our team will actually, SiteWire has an internal construction team with GCs trained at making sure work's done to code. I've seen tough cases where they did some work but wasn't done to code, so we didn't advance the funds until it was fixed. So they have an internal team of GCs that look at draws, thousands and thousands of draws. Once they approve it, they send it to us, and then we QC their work. And then if it's a loan on our balance sheet, we have an internal second set that'll approve it. And if it's a loan that we're servicing for another investor, we will ultimately reach out to that investor with our recommendation, which at that point would be to fund the draw. Once we get lien waiver and the right things to make sure title's still clear.
And we do fund draws when the work has been done or the materials have been purchased, right? We're not advancing.
Yeah, it's a common misconception is like, the borrower, especially new borrowers, right? They'll just write a deposit to a GC. GC says, I got to buy materials. A new borrower will cut them a check for $8,000 and then they hit us up for a draw. It's like, sorry, like we can't, we lend on physical improvements to the collateral. Also, what's funny is you can buy $4,000 set of appliances, stick them in the garage, get zero for it. And then if a handyman just lifts them into the kitchen and installs them correctly, you get the $4,000 advance. Same thing with flooring. Yeah. Like you can buy a LVP, have it boxed up in the garage. You spend $3,000 on your flooring material, you get nothing. But the second you install it correctly, then you're credited the advance. So we can only pay for improvements done to the property, improvements done to the collateral, essentially.
Because I've seen other lenders advance on things like that, and then the appliances disappear or the flooring disappears. But thank you for that clarification, because that question does come up, because it is risky, right? The last thing we want to do is give a borrower a bunch of rehab money and then they take off and they don't rehab the property, and you're, as a lender, sitting there with an unfinished project.
I'm hoping that those borrowers are watching this and then they get scared away and they go borrow from our competitors,
Well, we actually, speaking of SiteWire, I'm pretty sure just a couple months ago, we had a borrower take pictures from a different property and try to pass them through our draw department, and they caught it because of the geo stamping. So it is very savvy for sure. Funny. Well, here, I love this question. I want you to, well, it's not really a question. I would like you to share an example of a deal that you loved and was easy to close, and a deal that we passed on. And you can do it in whichever order you want.
I mean, I remember the declines. I don't remember like cookie cutter. The issue with cookie cutter deals is I will qualify them and I don't hear about it again.
Yeah,
that's
those are the best deals.
Yes, I love those. Like the ones I don't know about, or like I'll see a borrower and they'll tell me about their deal and our team, and I'm like, who are you? And then that's really a testament to nothing was interesting on their background. Yeah, they bought a good deal where the value wasn't like in question, like the budget wasn't inflated, like everything was just really good. So.
And you don't.
We have a lot of those
servicing.
Yeah, exactly. They're not a topic in service. They're not a headline. So you don't want to be a headline for your hard money lender. I will say we have one borrower in Little Rock, Arkansas, that is buying several rentals per month with us, and so that's pretty cool to watch the portfolio grow to a couple hundred rentals, and just being a part of that journey has been pretty cool. those deals are very cookie cutter,
Yes.
and they fit our investment thesis very, very in a very good way. The declines, I mean, the way I see it is if I don't catch mortgage fraud once a quarter, I probably missed it. And that frightens me. So I'm like, oh man, I haven't caught anything weird in a couple of months. Like there's probably going to be an issue here, you know? So, but no, a lot of the main issue we have in private lending, which most people have to be careful of, is the non-arm's length transactions. That's really, if you had one thing you wanted to get very good at to not make a bad loan, it would be making sure that the facts that you're given match the truth of the loan. That is by far where you're going to take where you could get hurt the most. So, for example, what I'm saying by that is, let's say that I took out a loan from a lender. At let's say I bought a house for 100 grand. It was a bad deal, and I started getting behind my lender. And Heather was my friend. Well, I could an easy way to solve this problem would be, let me sell the house to Heather for $200,000, you know, off market, and send a bunch of crappy, you know, comps that don't make sense to my lender. And then we're kind of working together, and the bank statements are photoshopped, and so just this stuff is really out there, and if you're not extremely diligent, you are going to get burned, especially when you're doing thousands of loans the way we do. Lending is low margin is the other thing. Like, you just can't really miss. You have to, one mistake can wipe out like 50 good loans. So you have to be very, very precise. So I would say the most important thing is understanding the story of the loan, making sure all of your deals are in good faith and that they're all arm's length transactions. So any kind of non-arm's length fraud, I mean, I have a bunch of stories, but typically it's somebody wholesaling a house to themselves or selling a house to themselves and sort of deceiving the lender, essentially.
Yeah. I think we had a situation where a husband sold the house to his wife.
Yeah.
Yeah.
Now, there's a right way to do it if you disclose it. So sometimes you'll have sometimes you have an inherited property, and you know the heir doesn't want to deal with it, and they sell to their cousin, and their cousin's a professional flipper. Like, that can be done in a legitimate manner. We just have to know the relationship going in and how they came up with the price and be able to structure a loan correctly. The issue is when you're withholding key information from your lender that would change the structure of the loan. That's when you tilt the scale into what I would consider mortgage fraud, which is extremely dangerous.
Yeah. Yeah, you catch a lot of it. I'm glad to see that. And even not just Andrew, but the team. I mean, we have a great underwriting team and processing, and typically they catch it before you even do. So, but there's always one out there. So talk a little bit about one of the things that comes up a lot with passive investors is, how do you guys diversify the portfolio and the funds, you know, and that can be not just markets, but like borrowers. And you kind of touched on that, you know, not getting over leveraged with borrowers, asset types, markets. Can you expand on that a little bit? I mean, is that something that is a thought when you're looking at these assets?
Yeah. So we look at concentration to per guarantor, which is, you know, let's just say a guarantor has a $200,000 loan with us, another $200,000 loan with us. At what point are we going to cut them off? Can you have 83 bridge loans with central lending, even if they all fit our guidelines? Well, no, because that would be too much concentration to one single point of failure, one guarantor. Same thing with markets. We don't want to be all in on Florida, because if there's a hurricane threat or something like that, or, you know, we're not on the West Coast, but if we were, and you had a fire, which they have out there. So we don't want to be, we don't want to have too much concentration risk in one market. We don't want to have too much concentration risk with one borrower. So we try to be diversified, but our core asset is that traditional housing. So we're not diversified in our asset type. And what I mean by that is we're not lending on gas stations and farms and, you know, casinos and hotels and banks. Like, we're we're really we're focused on the 1 to 20 unit residential space, because we believe like if that fails, then we've got a pretty big problem on our hands.
Yeah. Do you guys look at exit strategies a lot in your due diligence, your initial due diligence?
Yeah, so we will of course look at we'll ask the borrower at application what their exit strategy is. You typically get 3 answers. Well, you typically hear it's a fix and flip, meaning I'm going to sell the property and pay you off when I sell. Sometimes the answer is I'm going to refinance this, make it a rental. Once in a blue moon, I hear the answer, I'm just going to pay it off in cash, which is like, if you have all this cash, why do you need a loan?
Yeah.
Sometimes there's a real story though. Like sometimes they are buying a deal and then they like sell a business, get a big liquidity event and wire a payoff and keep it. So
I've seen that.
So that doesn't happen very often. But most often it is selling the property or refinancing. Ideally, we want both to work in case one of them fails.
Yeah.
But we do test the viability of each. We're going to test if their exit strategy is to sell. We're going to test profitability of the deal, after realtor fees, holding time, and all that. And if their exit strategy is to refinance, we're going to test what we know about. Now, we don't have a crystal ball. We don't know what the financial markets will look like when their project is done in 6, 9, or 12 months. But we will test the finished asset, what we think the rents will be at that time versus what we think the refinance market will be at that time, see if that asset qualifies. So we basically test the future asset with today's financial markets, see if it pencils out. But ideally, all assets work with both asset strategies. And we're a little bit nervous when, like, if somebody's building a luxury house, let's just say we get requests where it's a luxury build, it's $1.5 million build, and it's a $3 million sale price. If that doesn't work, it's not cash flowing as a rental. So that gives us a lot of pause. So we really like when there's multiple exit strategies.
And we also offer what's called a DSCR product. Why don't you expand a little bit on that? I know that most people that aren't actively investing don't really understand what that type of loan product is.
Yeah, so DSCR just stands for debt service coverage ratio. And the main qualifier of the loan, basically the main metric. So when you get a normal loan, you go to your bank, your bank's going to look at your personal income, see if you can service the debt that you're putting, the additional liability you're taking on. The debt service coverage ratio is a little different. It's a commercial instrument, and the main qualification of the loan is, does the rent service the loan's debt? It really doesn't care so much about the guarantor's personal income. It cares about the income of the asset versus the debt that you're putting on that underlying asset.
What is their ratio for that they typically require?
Well, it's different everywhere.
Yeah.
I mean, the higher the better. So if you're 1.25 or higher, you're normally going to get really good rates. If you're 1.0, you're typically going to get the maximum leverage. But there's niche products. If you're under 1.0, usually at lower leverage, higher fees. But I just, when someone's doing a deal under 1.0, you just got to ask yourself, why are you buying a deal where the rent is $3,000 and your mortgage is $4,000?
Right.
Usually it's a flip that went sideways or something weird is going on. It's usually a deal that doesn't make a lot of sense.
Right. Yeah. So we do try to help our borrowers, have an exit. And this is important for you guys that are on here that are passive investors, with us or looking to invest in a debt fund. It's important to know that as a lender, we're looking at those types of things, backup plans, because real estate is not a perfect scenario. I've done deals that don't always go the way that I thought they would. I know Andrew's done deals. And so we look at that with our borrowers, what is the backup plan? I also think being in that traditional housing market is really important because as a fund, the risk is we might have to foreclose on somebody, and we need to look at what our exit is and how we're going to manage this asset if we can't sell it. And so I talk a lot about being in that affordable housing market or traditional housing market space, because I think there is more opportunity to have different backup plans than just one, being in that high-end luxury home space. It's not to say that you can't make money and, it's not it's not a good investment. But for us in our model, it just doesn't fit. So I appreciate, the approach that you take with that. So let's talk a little bit about, so we've talked about, the asset class, our due diligence. Let's talk a little bit about how you evaluate a deal if you're a borrower. And then I'm going to talk a little bit about, as a passive investor, how to evaluate it. But I think we have such a good role going here with kind of talking about the due diligence and diving into the assets. I don't want to stop that.
Yeah, I mean, what's interesting about deal evaluation is a lot of people think, we're a numbers-based operation. We have guidelines, this and that, and they think if they just learn our numbers, like the deal will work. And really, it's kind of backwards, really. So what's interesting about us is while we're very analytical here, we actually start with the story of the loan. And once we understand the story of the loan, we validate that story with all of our due diligence, all of our metrics, and all of our numbers. We don't just kind of put numbers in a spreadsheet and hope it works.
Mm-hmm.
So we always get the story of the loan. Normally, what we're looking for is a reason why the loan makes sense for the borrower. Why is the deal, like, the money's not cheap. We're talking 9, 10, 11, 12% debt. We're talking 1, 2, 3 points. It's convenient. It's fast money. It's high service, but it's not cheap. So we want to make sure that these loans are in the borrower's best interest, and we want to understand why they need it and how are we helping them. And typically, these bridge loans are solving a fundamental problem with the asset. We want to understand what that problem is, how they're solving that problem, and how we help in that overall picture.
Yeah. That's a great point. I worked with an underwriter years ago, Doug, and he used to call it storybook lending. And we would go to what we called at that time credit committee. And he's like, tell me the story, and it's interesting. We just met with our processing team for our quarterly meeting today. And a couple of the processors were talking about their experience in the traditional banking world. One worked for a credit union, and they said it was very black and white. It was, you checked the boxes, and these were our guidelines. And they have a little bit of frustration because it's not clear. It's not black and white. And I said, it's storybook lending. You might have a cruddy property, but like you talked about this, somebody in maybe a challenged market, but they've got tons of experience. They've got a proven track record. And you might have a really strong property and but a challenged borrower. So the story has to make sense.
Yeah, we actually had a good day today with the sales team. They submitted a lot of loans, so credit to them. I remember 2 scenarios today. One of them was the purchase price was more than the MLS listing price on Zillow, which can be okay. It maybe there's a competitive bidding scenario, whatever, but it's just an interesting thing. Like, okay, if this got listed at $300,000, why am I looking at a purchase contract for $320,000?
Yeah.
What's going on? And so I probably drive the sales team a little crazy, but we're not really ready to qualify that loan until we understand, did the listing agent misprice it? Why does the buyer feel so good about this? Like, what's going on? So that was one. Another one today, I can't remember the purchase price, but I looked up the property and it had just sold like 2 months ago. So, and it was in a non-disclosure state, and it was an entity seller. So it was an entity seller, entity buyer, recent sale, non-disclosure state. And so you can't just kind of push those through and hope for the best. You really got to understand what's going on and how does this deal make sense? How my buyer find it, and so on and so forth.
I think I heard about that file last week, and the new purchase price was a few $100,000 more.
Well, no, I'm talking about a new deal that just got submitted for screening today.
Okay.
Yeah.
There was another one similar to that, and it had sold to an entity back in like May, and a new buyer was buying it, and a lot more. Yeah,
well, actually, we have another. Yes, no, you're right. We do have another file that, it sold for $800K. like a year ago, and now it's selling for 1.6 or something. And so you're trying to understand, okay, how do we basically double the value of this asset in a year? How does that make sense? So, and there could be a legitimate story there, but you just have to really dig a little bit deeper.
And I think as a borrower or a broker, the more upfront you are with some of these questions, and the easier it is for our team to understand it instead of us digging and finding it. Because when we find it and nobody's explained it, it sends red flags up, right? We're on high alert, like what's going on?
Yeah. What else have you not told us?
Yes. And it makes us dig into them more. And a lot of times it's very explainable, not always. But those are always very interesting. So I get a lot of, and you kind of talked about this, people use that term, what's your credit box? What do you guys do? What are your guidelines? If you could just give like a high level, and you've already alluded to the fact that it's just not black and white. I mean, we do have guardrails, right? But if you could give like some direction for our borrowers and brokers that are on here,
sure.
What would you say, kind of high level?
Yeah. So I would say, we are doing first position loans, backed by what I consider to be traditional housing, where blue, white collar, normal, traditional people work and live. We are in the Southeast and Midwest U.S. markets. Those are the three sort of non-negotiables. Our loan to value is and loan to ARVs anywhere from 70 to 80%. Our loan to cost is going to be 75 to 90, 92 on a very strong deal. And that scale will slide based on credit, experience, background, and also the relationship they have with us.
Okay, I think that's definitely helpful. Talk a little bit about internally our structure as far as approving a deal. Like talk about, the deal room, decision desk. I think that's interesting for people to know. Like, it's quite a process for people to get a loan from us.
Yeah, I mean, we're probably scaring off the brokers who want the easy money, and that's okay because we, But anyway, it's a very easy and good process if we know you. But if you've omitted a key detail, or we don't know you, or there's a background issue, or you don't want to share your bank statements with us, or if you're borrowing money from 7 people to fund your down payment, you're not going to have a pleasant time here. So if it's a strong deal, we're going to give you white glove service, and you're going to close in a couple days. If you're borrowing your down payment from 17 people and you're rude and don't work well with us, that's going to be challenging. Our process basically kicks off with an application at centrallending.com. We've kind of taken on the project of developing our own borrower portal, so it's proprietary technology to us. Brokers are going to be able to submit deals. Soon it's going to be white labeled, by the way, to enhance third-party originators. Really, application is the first step. Once the application comes in, I will review the deal. If it's a purchase, I'll review the contract, and then I will essentially either qualify the loan if it kind of makes sense and if it looks pretty cookie cutter, or if there's something that looks strange on it, like the two I just talked about, I might refer to the sales team to go get a few more answers before we qualify the loan. At that point, we'll either qualify the loan or cancel or decline the loan. Once we qualify the loan, we've already really made the decision to fund it, as long as the key data points check out. What I mean by that is, you told us a bunch of data points, such as the purchase price, the budget, the ARV, the as-is, your background, your experience, your credit score, all that stuff. So we kind of know all these data points. Once I qualify the loan, if all of these data points check out, then we're going to fund at the original terms we quoted, which we're very proud of our track record and always funding kind of what we've agreed to fund. Where we run into a lot of issues is when someone tells us their credit is 750 and it comes back at 660, then we quoted 90%. Now we got to do 80 or not do it at all. And so we really need that initial submission to be accurate. If it's accurate, our process is very good. If something is changing in our due diligence process, then we'll have to go back to the borrower and say, okay, you told us you had 6 deals, but really you have 1 rental and you've done 5 projects for other investors. You only really, we qualify that as 1 experience. So then we have to have a difficult conversation with them about, I know we told you 90, but we thought you'd flipped 6 homes. You only flipped 1. Now you're at 85%. So, but as long as they can still support that deal, fund that deal, then we will go ahead and get them closed.
And we don't give them credit for track record past deals unless that we can verify that. Is that correct?
Yeah. So our look back is 2 years.
Okay.
So we're going to count rentals you currently own, and then we're going to look back 2 years at ground up construction projects you've finished, and rehab projects that you've finished. And we do run a CoreLogic report. We'll look at owner of record. We'll tie it to our guarantor. It's best when it's the same entity doing our deal. If it's a different entity doing 10 deals, and then now we get a deal, it's the first deal with this new entity. I'm like, okay, did you just make an operating agreement to make me happy, or is this really kind of your deals? So we try to kind of, again, it's back to the store. Does it make sense? Were you 50%? Now you're going on your own, or did you just create this paperwork to get a better deal from us?
Tell them a little bit about why we only lend to entities. I don't know that everybody's aware that you cannot just come to us and get a personal loan.
Yeah, I mean, we are a private lender. We are not subject to consumer finance laws and regulations. We're not subject to any Dodd-Frank stuff. I get a couple loans a week where I could lend to an owner occupant because their FHA loan just blew up. And the realtor calls me in a panic, said, I heard you guys could fund in a couple of days. I got a full file for you. And I say, thanks, but no thanks. I'm not interested. I'm not doing anything that can be considered consumer lending. We do what's called business purpose lending, meaning we can lend to other real estate businesses who are in the act of investing in real estate for profit. Consumers are buying houses to live in, paying rent, groceries, cars, those sort of living activities. There's a lot of regulation meant to protect the consumer, which I don't want to get political or get into regulations, but the point is those laws are on the books with the idea of protecting consumers from loans they can't afford to repay. We don't really touch that. We work strictly with other businesses who are trying to flip and rent and buy real estate property strictly as a business practice for investing.
Okay. And I think you mentioned this earlier when we first started, is we also do require personal guarantees from the members of the entity.
Yes.
And as a passive investor, that is just an added layer of security. I mean, one, we only lend in a first lien. We're trying to lend with equity in these deals, but we also do require personal guarantees in the event that, we potentially foreclose on something and experience a loss. There is the potential opportunity to possibly go after a personal guarantee. That's not meant to scare borrowers and brokers off, but a lot of our investors look at this like, what's the risk? Well, the risk is we might have to take something back. These are the things that we've put in place to protect you as the investor and us as the lender. So, okay, we've covered a lot, and I didn't even get to any of the passive investor stuff, but that's okay. This is a good conversation. I do see some questions coming through. I think because we're trying to wrap this up in an hour, so we're not keeping you guys all night. But I was thinking maybe we address some of these.
So Milton says, curious if you offer construction to perm loans for multifamily from 1 to 8, from 1 up to 8, 16 units.
Polk County.
One up to 8. Hi, Milton. I don't know if you're still here. Looks like that came in a little while ago. So we do not offer new construction rolled into permanent amortization financing in a single close. It's a very niche product, very hard to find, particularly in business purpose for investors. And the reason for that is I think the underwriting for those two things is very different. The underwriting for forced depreciation on a ground up construction versus the underwriting for a long-term DSCR, these are different financial instruments, and different investors have an appetite for those financial instruments. Ground up loans are thought of as a little bit riskier. Typically, investors who take those on want a higher yield. DSCR is typically thought of as lower risk because the deal's stabilized, there's a tenant in there, the rent is covering the mortgage. So you're getting a much lower rate. And typically the investor pool for that is just a different investor pool. So they're different financial instruments. For us, we would split them into 2 loans. And to make it even more confusing, if you go from 4 units to 5, you're also changing asset class. 1 to 4 is residential real estate. 5 or more is considered commercial. So a 5 unit is really considered an apartment. So your thing said eight buildings, I think 16 units. So if you have 2 duplexes on 1 APN, that's 4 units. That's underwritten as a residential property. If you have 3 duplexes on 1 APN, that's 6 units. That's now a commercial property. That's underwritten the same way as a 100-unit apartment building. So the jump from 4 to 5 is really massive in terms of what it will allow or disallow in the financial markets. Sorry, I messed it up. Guys, we're trying to scroll the screen and deal with it.
Ellen had a question. Let's see. There you go. There's Ellen's question. Elwin. If the rent on a property can cover a loan amount greater than the ARV, can I get a DSCR for that greater amount, or is the DSCR limited to the ARV?
That's a good question. So a lot of people ask about DSCR. So DSCR really, there's 2 things that can limit your loan. So the appraised sale value of the house is one limiting factor. So for example, if you have a house that appraises for 500 grand, and let's say your LTV is, let's say your house appraises for 200 grand, more typical model, and your LTV max is 75%, it's $150,000. So that's one metric, is loan versus appraised value. But also in a DSCR loan, you need the rent to cover the mortgage. So for example, if the rent for that same asset, that same $200,000 house, if it doesn't cover the mortgage on $150K for your credit profile, that's going to also lower the loan. So you have a max loan amount in terms of what loan amount will cash flow, and then what loan amount is supported by the asset's collateral value. So you have to take the lesser of the 2. They both have to check out.
Let's see here. Ron says, so do you lend on personal credit?
So we lend on, so we look at the deal first. The deal is the most important thing by far, but we do a soft check on personal credit just to look at your behavior with other creditors. So if you're breaking a bunch of financial agreements with other lenders and other financial institutions, we want to know about it. Now we have a high tolerance for sort of running up credit cards in between jobs. If you miss a utility bill, not a big deal. Just explain it. Again, we're a storybook lender, but we definitely take credit into effect. It's a very important data point.
Well, and credit scores are so swayed by different things.
Mm-hmm.
Fernando, we see your comment. We will reach out to you. Looks like Fernando's looking at possibly collaborating with us.
Awesome.
So we will reach out to you. Let's see what else we've got here.
Cool.
Start putting your questions through. I've got a couple too that came ahead of time. So you talked a little bit about this, but we didn't get too far in the weeds. Closing time. What really is an average closing time?
Well, it's funny. We just looked at this today for DSCR loans. So I was concerned about our closing times, and we had a team meeting today, a long one, our quarterly huddle, to try and get our processes dialed in. So our average closing time, I shouldn't say average, median closing time for a DSCR, 30 days. That's come down considerably from the first half of the year into the last couple of months. We've really kind of dialed in DSCR a lot better. And then bridge, our goal is 5 business days. We've done as little as 2 business days. It's also, we've had loans where it's taken, 8 months to close,
Yeah.
right? So sometimes a ground up, they get the file in, they get the appraisal going, and then they just get stuck in permitting. They change their mind. The county wants a tree removed, like whatever the thing is. So we've had ground ups where they've gone back and forth with the permitting department for many, many months. But our RTL loans, our short-term loans, close very quickly once we have everything we need.
Okay. Also, we have the link in the comment section. If you have a deal to submit, make sure that you copy that link or visit that link. You can submit your deal there. Let's see here. We do not service Los Angeles, California, unfortunately, David. We are not lending actively in California at this time. This is a good question. I've heard this one come up in meetings. Do you do DSCR on Airbnb purchases?
Yeah, we do. So DSCR for Airbnb is very interesting. What I tell borrowers on DSCR for short-term rental strategy, what I tell borrowers is do your pro forma on a long-term rent basis. See if it cash flows on a long-term rent basis, even if your intention is to make it a short-term rental. Because if it cash flows on a long-term rent basis, it's a much stronger deal. If it doesn't, if you couldn't sign an annual lease and service your mortgage, in my opinion, it's a much weaker deal. And now we're kind of, if you need the delta from long-term rent to short-term rent to make your deal pencil out, it's a much harder deal to get comfortable with.
Okay.
To use short-term rent as the qualifying rent on a DSCR loan, typically, best case scenario, you have operating history on the subject property. You can look at seasonality changes, all that. Also, we can look at if other short-term rental property managers can give us an opinion of the short-term rent in that market. And then lastly, we can take an appraiser's opinion of short-term rent market. But it is a much harder scenario to approve if you need short-term rental income to qualify your loan. Whereas if you could just use long-term rent to qualify your loan and you make it a short-term rental and get that extra income, that's fine. But if you need short-term income to make it pencil out, it's probably a fairly weak deal to begin with.
Okay. Somebody asked, do we service our own loans?
So we have a servicing team of I believe 7 now.
Mm-hmm.
And we do service our own loans. And when I say servicing, I mean assistance with payment collection, boarding, capital markets, construction draws, extensions, workouts, loan modifications. We perform all of these high value functions for making a loan payment and getting your account reconciled and all that. We use sub-servicing companies. We use FCI and BSI for sub-servicing. They're licensed, regulated. They cross their T's, dot their I's. They record the release of mortgage and take care of some of these other limited payment functions.
Yeah, and on that note, for any of you that are on here, because we do sell notes, when we originate our loans, we sell that paper sometimes to individuals. We actually have quite a database of note buyers. And one of our note buyers said that they call what we provide concierge service, because it's not common to go buy a note and also have a firm that provides those high level responsibilities, right? Tracking payments, making sure insurance is paid, taxes, managing draws. So we do that as a courtesy, not only to our investors that buy our notes, but also to our borrowers. Mm-hmm. You know, they would prefer to call us internally to get a draw or, ask for an extension. And so it is a pretty big service that we do provide. Somebody said in here, do you use any AI for doc verification to save time? That's actually interesting.
Oh yeah, I love it. I use AI all the time. We've built a lot of custom GPTs for our due diligence. We've built a document audit GPT for before we send out final loan documents. So what used to take a paralegal 20 minutes to scan every page and check every typo. We have a custom GPT that will do a document audit. I don't want to get anything too proprietary, but we do use custom GPTs to read PDFs and tell us about the deal and save time, and it's extremely powerful. That's a very interesting topic, but we absolutely use today's latest and greatest technology. We lean into technology to make us more efficient and to make us a better company.
We also just had one of our team members build out an interested party verification through AI.
Yep, a related party
Related
search.
party.
Yep, so we can kind of put a bunch of documents in, and it can cross-check things. And I don't want to coach anyone on how to lie to us, but we're pretty good with kind of we believe heavily in the technology. It's just going to get stronger, and being able to understand it and use it is going to make you more efficient, which is going to allow you to compete in the open market moving forward.
One of the things that comes up a lot that I know is important to you guys as borrowers, especially when you're in the middle of these projects, is the draw process.
Mm-hmm.
One of the questions that came through is, what does that timeline look like? Because I know as a borrower, you're trying to pay contractors and get reimbursed from materials you've bought. So it's a balancing act. What does that process kind of look like from a time perspective?
Yeah, I would say we're a couple business days at this time, and we're trying to cut from 3.5 business days to 3 to 2.5,
Yeah.
2.5 to 2. One thing that really holds up the draw time is getting the SiteWire report back.
Mm-hmm.
So if you request a draw from us, but we don't get property photos for 4 days, we're kind of starting behind the 8 ball. That's the first main thing that we need from the borrower that's outside of our hands. The second thing is lien waivers. Sometimes we're chasing people down for lien waivers. But if those two things are done in a timely manner, we only need a couple of business hours to really process our end of it. So, I've seen them go out in a day,
Mm-hmm.
but a couple of days is a good rule of thumb. I mean, if you need the money like instantly, I would say, plan ahead and request the draw a couple of business days before.
Yeah. Once they do use the link and take the pictures, how long does it take to get the report back from SiteWire? Is it 24 hours, 48?
Yeah, again, and they're a company, they have bandwidth issues. They have thousands of reports. They have a whole GC staff that processes these. But yeah, generally a day.
Okay. James has a question. He says, if credit score is 640 on 2 properties, I rent one, values at 80,000, own the property I live in, value at 200,000. Can you do a loan for 150?
So unfortunately, the one that you live in, we couldn't touch. The one that's rented at 80,000, we'd be able to offer you a loan on that as long as it was in one of the markets that we feel comfortable with. So yeah, the rental property would be fine. A 640 would be fine. If it's rented and stabilized, you're probably looking at a loan of 45 to 55K, something kind of in that range.
And James, I don't know if you were on here, but there is a link to submit your deal in the comment section that we put just a little bit ago. Maybe we can repost that.
Yeah, and what I would say is if there's a way to lift that property value closer to $100,000, that'll really open up the DSCR market where you get extremely good interest rates. So maybe there's a little bit of work we could do to it to kind of add a little value, boost rents a little bit, and then potentially get the credit up to about a 660, 680 is where the DSCR market gets pretty attractive. And then we could get you in a very low interest rate loan, something on the order of 6.5%. We do not have a minimum loan amount, Joan, for bridge loans. For DSCR, minimum is 50,000. For bridge, we don't have a minimum loan amount, but borrowers do not borrow 20, 30,000. Just the time, the paperwork, the processing fees, generally not worth it.
And that deal submission link is back on there, James, if you want to submit a deal.
But yeah, I actually prefer the lower loans. I really like 30, 40, 50, 60K loans spread out all over the place. I don't like these, $10 million loans to one thing and hope for the best.
All right. Any last questions?
All right. Well, good turnout.
Yeah,
Really.
we'll do this again.
Yeah.
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 We're going to upgrade our technology a little bit, but for our first one, I think it went well.
All right.
Again, if you guys have deals, you can follow the link and submit a deal, and somebody will get in contact with you. I know we didn't talk a lot about the passive investor side of things. I just felt like the conversation was flowing so well, talking about really the due diligence, what our guidelines are. And, that's applicable to you guys as passive investors. You need to understand what you're investing in. And
if we didn't scare them away, submit your deal. And then after we get done ripping the deal apart, you can buy the note from us if you want to.
Here's a good question, though. Do you work with foreign nationals with no credit score?
We do, but you can't be. So people use the term foreign national kind of broadly. The issue with that is we need to know, is this someone from Canada with a vacation rental visiting back and forth, or is this somebody who's here illegally and we're just calling them a foreign national? So we really need the story, where they live, what the plan is. And as long as it makes sense, we can cover that loan.
All right. I think we're going to wrap things up. Again, thank you for taking time out of your evenings to be here. There will be a recording as well. I think we're going to actually put a QR code up as well for Andrew's contact information. You can connect with Andrew there. And yeah, if we can help you guys with your deals, if you're interested in passively investing, I'm more than happy to jump on a phone call with you. That's the contact or the QR code to my calendar there as well. But until next time, take care.
All right.
Let us know what we can do to help you guys.
Yeah, absolutely. Thanks everyone for showing up.